Hello and welcome to Absolute Trust Talk. This is another Facebook Live version of our podcast here at Absolute Trust Counsel. And I'm Kirsten Howe. I'm the host, and I have a guest today, my friend Margaret Shop. And I'm going to introduce her formally in just a minute, but I would just want to let you know what we're going to be talking about. We have a very high exemption from estate tax. The federal estate tax exemption amount is very high, $11.7 million. And that means that most of us are never going to worry about filing an estate tax return. However, there are reasons why some of us might do it even if we don't have to. And Margaret is the expert, as far as I can tell, on estate tax returns. So we're going to be talking about estate tax returns, what goes into it, how you do it, and why you should think about filing it, even if maybe you don't have to. So that's what we're talking about today. Before we get to it, you know I have to do my housekeeping. First of all, we're going to be recording this. So if you're watching live, that's great. We're happy to have you. We love having audience members. But if you want to watch it again, or you want a friend to watch it, it'll be on our website as a video in a few days. Also, it will be a podcast, which is just audio, and that you can find wherever you find podcasts. You know, if you listen to them on your phone or on your computer, wherever you listen to podcasts, it will be there also in a few days. Just give us a little bit of time. Second thing, if you're watching live, we will answer questions at the end. And by we, I mean Margaret. You don't want to ask me any questions. So we will answer questions at the end. Just go ahead and type them into the comment section there on Facebook whenever you think of a question, and when we get to the end, we'll answer them. Okay, so that's the housekeeping. We got that out of the way. I think I remembered everything. Now I'm going to introduce my wonderful guest, Margaret Shop. Margaret is a CPA. She's been a CPA for over 20 years. She is very unique, I think, in that she really does focus on trusts, estates, and estate tax returns. She is an expert in that, and really she's the person that I always go to for those kinds of things. And my clients love working with her. They love her. Margaret's company, Shop & Company, as I said, they focus on trust and estate returns, and sometimes those are income tax returns, and sometimes they are estate tax returns, and that's what we're going to be talking about today. I think a lot of times CPAs, because we don't do that many estate tax returns anymore, a lot of times CPAs, they just do one here and there, and really I think you want somebody who does them all the time. And that's what Margaret and her folks do. They do them all the time. So she really knows what she's doing. Margaret is a member of Cal CPA, of course, and she's on the board of Cal CPA East Bay. So she's very well known in her community, and my community too. Everybody knows Margaret. So without further ado, I'm going to actually allow her to start talking. Margaret, thank you so much for being available and sharing a little bit of your time. I know this is starting to get to be a busy time of year for the CPA, so thank you so much for being here.
No problem. Thank you so much for having me and allowing me to discuss this topic.
Great. Yeah, I think it's something that people have some vague awareness of, and they just don't really know enough about. And when we get a little deeper into it, there are certain aspects of it that I have to talk to some of my clients about, and it's just a mystery. So I think this is going to be very helpful. But just before we get started, why don't we just get the basics of federal estate taxation out there so we know everybody understands what we're talking about. So just very generally, how do we calculate the federal estate tax that is owed when somebody dies?
Okay. So first thing, I'm going to get a little bit of my housekeeping and my assumptions out of the way. I use a lot of examples to explain things because I think it's easier to understand.
Perfect.
When I throw an example out there, I do a lot of things. One, I round numbers. Instead of 11.7458, it's 11 million, just to keep it easier. Every time I say something as an absolute, like portability. There are a litany of exceptions that go with that. Every circumstance is unique, so everyone's probably got a page of exceptions that go with every statement. I know this is sexist, but I say the husband dies first, wife is the surviving spouse. It just makes it easier and reduces on the number of variables. So
I say that too, every time.
Every time it's the poor husband kicks first.
Yeah.
There you go. Wife survives and she survives for 10 years. That's just the fact pattern every time. Makes it easy. Another thing I want to say, and this is something I learned 3 or 4 years ago, if you are not a US citizen, you have unique circumstances. As soon as this broadcast is over, you pick up the phone and you call Absolute Trust Counsel and you ask about a QDOT. That's it. So this discussion applies to US citizens.
Right.
So, okay, got that all out of the way. So how do you calculate the federal estate tax? Actually, it's not that hard. But let's start with definitions first. What is the estate tax? The estate tax is a tax on the right. You have the right to transfer property at your death. It's a transfer tax. So like when you sell your house, you know, when you get that whole list of things that you got to pay for, there's that transfer tax to the city or the county or whoever. It's the same thing, except on a grander scale. We talk about the exemption amount. What is the exemption amount? What's that mean? That's the amount you get to transfer for free. That's all that means. And another thing we throw out there all the time is the decedent. Who's the decedent? This is a dead person. That's the person that died. In our case, will always be the guy, the dad, the husband.
The husband, right.
Right, the husband. So how do we calculate the estate tax? Not that bad. The estate tax is calculated on the net assets of the decedent, and you take that number and you subtract the exemption amount. If there's any amount due, any amount left over, you apply 40% to it, and voila, there's your estate tax.
Right, and you said the net amount of the estate. So the value, we subtract out loans and mortgages, we subtract out debt, right?
Mm-hmm, mm-hmm.
Okay.
So the net assets. So when I say net assets, the process to get to net assets is the following. We get a laundry list of all your assets. Your house, your 401k, your IRA, your bank accounts, your jewelry, your hobby tools, your annuities, the loans to the kids. Kids don't count, but the loans from the kids count. Anything that you have of value, we take a laundry list of that. And then we start looking at things that reduce the value of those assets. And that's what's called the deductions. So most people, they have a home, they have a mortgage on that home.
Right.
And that mortgage is called a deduction. So you have a $3 million house, $1 million mortgage, the net asset for that home is $2 million. Right? So that's kind of how net assets are calculated. Other deductions to think about: credit cards, outstanding utility bills, outstanding federal and state taxes, and that can be a big number.
Right.
Yeah. It's like, oh God.
Yeah. You gotta pay your taxes in the end.
You gotta pay your you can't escape those even if you die.
Right.
But you funeral costs are a deduction. I know. No getting out of it. So sorry.
Well, and also there are other kinds of deductions that people wouldn't necessarily
think about,
be able to come up with on their own, such as funeral expenses.
Yep. Funeral expenses. And we're talking everything from the caterer to the postage to send out the notices to the advertisement in the newspaper,
right?
The stipend, or not a stipend,
whatever you pay to the priest. Yeah.
Right. I don't know. All of that goes into the mix.
Right.
Lawyers' fees and accountants' fees
Right,
go into
right.
the mix as well.
Right.
Whether they're actual or estimated, we can make a check an election on those. So those are the deductions, and our thing is we're hunting for deductions.
Right.
We loved
Right.
assets are great, deductions are better.
And one other one, which probably most people wouldn't think of, and it's kind of really relevant to what you said just a few minutes ago about if you're not a U.S. citizen, get yourself to a lawyer. Anything you leave to your spouse,
Mm-hmm.
if you are a U.S. citizen, is a deduction.
Mm-hmm. Yeah.
If you're not a U.S. citizen, it's a whole other deal. Yeah.
Exactly. Yeah. Well, and not only that, like we talked, like you said before, the exemption amounts 11.7 million. Well, that applies if you're a U.S. citizen. If
Right.
you are not, that drops like a rock. I mean,
Right.
it's way low, but there are ways to address that.
Right.
So,
okay. So if after everything is done and you found all the deductions you can find, and your estate is worth more than the exemption that you have, your family is going to have to file an estate tax return. And that's where, Margaret, that's where you come in. But there also are times where the estate is less than that amount. And I'm talking about when there is a surviving spouse, it might be a good idea for the surviving spouse to just go ahead and file that estate tax return anyway. So why don't you talk to us about what the heck I'm talking about?
Okay. What you're talking about in a nutshell is called portability. And in my mind, portability is a gift from hi, this is Kruger, my cat. Yeah, Kruger's going to make an appearance. He always does. Anyway, portability. Okay. The IRS gives a couple of gifts. In my mind, there's 3 gifts the IRS gives. One is the $250,000 exclusion when you sell your house.
Right.
2, a Roth IRA.
Right.
And 3, portability. And I think portability is the one that could have the most value for people. But let me explain what portability is. So first, if we go back to the very beginning, estate tax is a transfer tax. It's a tax on your right to transfer property. But there's one big exception, and you alluded to it earlier, is if you transfer property to your spouse, it doesn't count as right. It's free. It's called the unlimited marital deduction. And attorneys and accountants throw that around like people know what we're talking about, and they don't. It just means you can transfer to your spouse estate tax free all day long. It doesn't matter the amount, right? So let's give an example, and we can explain that because it's easier to explain via example. So fact pattern is the following. Husband and wife, married for 50 years. They have 2 daughters. The husband and wife were super smart. They went to Absolute Trust Counsel. They got all their affairs in order. Everything's titled properly. All is right with the world. And husband dies. Their estate plan said the following. Everything that the husband had went to the surviving spouse, right? And once the surviving spouse dies, everything goes to the daughters.
Right.
That's
very typical
fact pattern, right? So here's the example. Husband had $2 million. That went to the surviving spouse, right? So in a sense, he's not using any of his exemption amount,
which
right?
is 11 million, right?
11 million bucks. So what he's going to do, because he's a nice guy, is he's going to give that exemption. He's going to port that exemption over to his wife.
Right. He didn't use it
He didn't use
whatever he didn't use, she can use.
She can get. Now, okay, great. Now she's got $11.7 million exemption. Why is that a value? Okay, so wife lives another 10 years, right? She had the $2 million that she got from her late husband. She has her own $2 million. And in the 10 years, that amount doubled. So now she's got an estate value of $8 million. When she dies, that exemption amount's only $5 million because that exemption amount changes, and the pressures or the factors that influence that exemption amount are like a discussion in and of itself.
Right.
But
the point being, the exemption amount could be reduced to a point where now the wife has a taxable estate.
$3 million taxable estate.
Right.
Then it's like, well, wait a minute. Husband gave me his unused exemption of $11 million. Presto changeo, you went from owing $1.5 million to owing nothing.
Nothing. Right.
So that gift, that exemption amount is valuable because that means you can transfer that amount tax-free to a non-spouse, the daughters in this.
The daughters when the second spouse dies. Right.
Exactly. So,
and that concept is called portability. That
concept is called portability. The husband is porting his unused exemption amount to the surviving spouse, the wife, mom.
Okay, but it doesn't just happen because
that's not my magic.
You actually have to do something to claim that unused exemption amount. The surviving spouse has to do something, and that's where you come in.
That's where we come in.
Right. So the thing that the surviving spouse has to do actually is file an estate tax return, even though they don't
have a taxable estate.
She's not required to. It's optional. Mm-hmm. But if it could save your daughters $1 million when you die,
mm-hmm.
That's definitely worth doing.
Yeah.
So, how difficult is it to prepare this kind of a tax return? I mean, I'm sure it's difficult for you, but is it not difficult?
Oh, it's difficult for the participant too.
Yeah, that's the thing. It's not.
They're not easy.
They're not easy.
So here's our process. So what we do is we have a checklist, and we've tried to take some of the jargon out of the checklist, but I will tell you the checklist is 15 pages long. So it's not, And usually someone calls, we'd like to talk to you about a 706. I say, that's great. Let me send you the checklist. You take a couple of days to take a look at it. And then we meet again and we go over it.
Right.
Because it's not intentionally intimidating, but it just has to be because we have to ask a wide breadth of questions, right?
Yeah.
So then we meet with the wife, the surviving wife, and we go through each page and we cross off things that don't apply. Do you have limited partnerships? No, cross it off. Get rid of that stuff. Do you have second homes? Forget it. Get rid of that page too. So we go through it methodically to make sure that we capture everything that's in the estate.
Yeah. Okay.
Because a lot of times people are like, whoa, I don't understand. How is that an asset? Or it's not mine, it's only his, or things like that. Yeah. It also, this checklist will outline the documents and stuff that we're going to need. We need to know if you're a citizen or non-citizen. We need to know if you had previous marriages and get documentation on that. We need to know who the beneficiaries are. We need to get the death certificates, the copy of the trust, copies of the will. If you've had to go to court to probate any of this stuff, that goes into the pile. We get copies of the appraisals and bank statements and last 2 years' tax returns, and just the litany of documentation that goes into it is, I'm not it's not easy, but that's part of the process.
Well, and you have a process, and that makes it easy, much easier for the clients. Yeah.
It at least gives them some structure as to how to go about this, right?
Yeah, they know exactly what to get because you lay it out. This is what I need.
This is the roadmap.
Stuff that I don't need. Yeah.
Right. Yeah, we've thrown out the crap that we don't need. And hopefully by the time you're all done, you're down to a 6 or 5 page checklist. You know, that's not as intimidating. We don't want to make this an intimidating process. It's just we're dealing with the Internal Revenue Service.
Right. You have to be thorough because it's the IRS. You don't want to leave something out. They don't like that.
No, they frown upon
they
that.
Get annoyed. Yeah, they get annoyed when you do that.
Well, and they're also cautious about how you're documenting things. I mean, value comes into play. These items are valued as of the date the decedent, the dead person, passed away. And that's important on a go forward basis. And so being able to not only file, the return itself is what, 5 pages. It's all the supplementary schedules. And we include everything because you're going to need this document 20 years from now, and trying to dig up a bank statement is going to be virtually impossible. But having it right there in that packet, no, I can prove that asset was worth X. Here's the statement. It just makes it's work at the front end to save you headache at the back end.
Right. Yeah. So you've prepared many 706. So 706, I don't know if we said that, but that is the form number of the federal estate tax return. And you have prepared many of these. I know that for a fact because I've seen them. I've seen many of them, and just a small sliver of what you've done in your career. Are there any common mistakes or impediments or problems that people have when they're working on a 706?
Yes. To summarize, in summary,
tell me what they are. Yeah.
Okay, so here's the deal. The 706, if you're filing just for portability, looks exactly the same as if you were filing a 706 as a taxable estate.
Okay.
The same thing goes into play. What some of the most common mistakes are is, and you alluded to this earlier, is you have a family CPA. The family CPA is awesome. They know all your deep, dark secrets. They know where all the skeletons are buried. Life is great. Let's get the family CPA to do the 706.
Right.
But they do one a century.
Yeah.
Right. And a 706 is deceptively simple. It's kind of like golf. Take the ball, hit it into a hole. How hard can that be? Until you actually try to swing at the hole and you're like, oh crap, this makes no sense. That's the way a 706 is. It looks great on the surface, but then when you start digging in, it can get a little hairy, right? Yeah. So the biggest problem that we see is having a preparer, no matter what, their intentions are awesome, but they don't do these all the time.
Right.
And then they do them a little, they kind of lose their way somewhere along the line.
Yeah.
We like to work with those CPAs because all we do is a 706. Yeah. That's it. We're not interested in the rest of the relationship.
Yeah. You keep the income tax, you keep doing those tax returns every year.
You're a family tax preparer. We partner with the CPA and kind of get this done.
Right.
So that's one of the biggest things. Another big thing is part of this 706 process is a form called an 8971. And what that 8971 is a gift to the beneficiaries. Because what it says, here is all the stuff you inherited, and here's the cost basis for all that.
Oh.
Which... you receiving it, you're like, not a big deal. You're going to throw it in a drawer somewhere.
You want to hang on to that thing.
When you sell those assets and your accountant says, what's the cost basis? Wait, I got that form. And
Right.
you haul that form out, and that's the form that says, here is what you're using in calculating your capital gains on the sale of those assets.
Right. Yeah. Very nice. Yeah.
And that's a byproduct of it. So that, and it kind of puts a stake in the ground. Here was the value as of the date of death. So this is what you're using going forward.
Nice. Okay.
Another common mistake is life insurance. So life insurance, you may get a check for X amount, but the value to the estate may have been something completely different.
Oh, right.
So you always have to reach out to the life insurance companies and say, I need a Form 712 to tell me what the value to the estate was. Boom. Another common problem is not taking the titling of the asset seriously. And you,
that's my job.
Was that house joint tenants or was it community property?
Right. Right.
Give me a deed, please.
Show it to me.
Those sorts of things are important in understanding the value, the basis, that sort of stuff. And also understanding that this is not an income tax return.
Yeah.
It's an inventory of your assets, your deductions.
Yeah.
It's an inventory of who the beneficiaries are and the values at the date of death.
Yeah. You just have to think about it differently. It's not.
You do. And you've been used to doing income tax returns forever. Yeah. And all of a sudden we're turning that on its head.
Right. Yeah.
The last thing I'm going to say, the second last thing I'll say is every investment has to be in there individually.
Oh, so you don't just say my Fidelity account. You say the Apple shares,
the Google shares, the Facebook shares. Yeah. And not only do I say the Apple shares, the Google shares, the Facebook shares, I say Facebook, ticker symbol, QSIP number, number of shares, value as of each share, and total.
Yeah. That's a good point. Yeah.
Yeah. So yeah, I mean, like I said, these returns are not super easy, but they're super worth it.
Right.
If you can take advantage of that that amount.
Portability. Yeah. Mm-hmm. Thank you for explaining all of that. I have to have that conversation with my surviving spouses every time. And it's like I'm speaking Greek to them the first time, and then I have to have the conversation again. And then I say, we'll talk to Margaret, and you have to have the conversation. And
we have a little sheet, and we have, the husband and the wife, and then we knock off the husband, and then we have the numbers move around to just because people learn it differently, hear it, see it, however, Yeah.
So maybe now I can have my surviving spouses watch this video, and then they'll understand it, and I don't have to explain it 3 times and then have you also explain it. It's just an unusual concept, and it takes a while. And
it does.
But we get there.
And it's important to understand, like right now, that exemption amount's 11 and change. And that amount will sunset in 2025.
Right. It's going to go down significantly. Right.
Nobody knows what the exemption amount's going to be. Right. No one knows what the estate tax is going to be. So, good luck.
So grab it while you can. Grab it while you can. Yeah.
I mean,
okay. I want to go to our questions because we have a few questions for you, Margaret. Let me scroll up and find the first one. Okay. Here we go. Do you have to get an appraisal of the real estate for the estate tax return, or is a broker comp letter okay?
Okay. Our first stop is an appraisal. They're not ridiculously expensive, and they do preserve the value.
Okay.
So they're what, $400 or something, and
This is the IRS. Don't mess around with free. Pay for an appraisal. Yeah. Okay. Do you include personal possessions like clothes, jewelry, furniture on the return? And if so, how do you value those?
Okay, so what we ask our clients to do is take an inventory room by room. Because if we tell them to take an inventory of the house, head spinning starts happening, right?
Yeah.
Right. Go sit in the room, take it. We had one client send us pictures of everything in the room. That was easier for her to do. You are able to have the trustee assign a value if it's a de minimis amount. If you have a home and the furniture is the furniture,
It's normal furniture.
It's normal furniture. You don't have any
You don't have Louis Couture's. Yeah.
Hundreds. There's no Persian rugs. There's nothing like that. Then you can say trustee estimated value. That's fine. However, in those cases, what we do is we do have you put an inventory together. We don't say household goods, $10,000. No. If you're going to shortcut the appraisal, we ask you for an inventory.
At least itemize. Yeah.
Right. Okay. So that's showing respect to the Internal Revenue Service and showing respect to the process.
Right. Okay. Okay. So, here's this, I think is the last question. And this is one actually I would like to know the answer to. And you would think I would know, but I don't think I do. If you do a probate, you have to have the property appraised by a probate referee assigned by the court. Mm-hmm. Can you use that as the appraisal for your estate tax return?
Depends. So the last discussion I had about a probate appraisal was with regard to an asset that was rather unique, shall we say? And the referee had no clue.
The referee blew it. Yeah.
The referee blew it. And granted, these were the kinds of assets, there may be 5 in the whole world. So really, it's not easy to get. So right. It does depend. And it depends on what they give you. And if you think it's too high or too low. I mean, let's just put it this way. You're not obligated.
You're not stuck with it. Yeah.
Right. You're not stuck with it.
Okay. But you could use it if you think it's right.
If you think it's fair, and if you think it accurately depicts the value.
Okay. That's good to know. Thank you for that. Okay, I think we've got all of the questions answered, and there are probably many, many more, but that's all we have time for. So, Margaret, I just want to thank you so much. You explained all of that. It's complicated stuff, but you explained it in a very understandable way, and I thank you, and my clients will thank you when they listen to this. So thank you for being here.
Thank you for having me. And like I said, it is a gift, and I like for people to know about it. So thanks for letting me get the word out.
Good. You are most welcome. All right. Thanks for joining us, and I'll see you very soon. Okay, so I hope you got a lot out of that. I know I did. That one question at the end was something that I've wondered about for a long time. So I'm glad I got a chance to ask her that. If you are a trustee or an executor, because of the death of a family member or a friend, you don't necessarily know what to do, and that's okay. You can give us a call. We here at Absolute Trust Counsel are here to help you. It's our job to make sure that trustees don't make mistakes. They don't forget any steps. So feel free to reach out. We are here to help you. AbsoluteTrustCounsel.com. And remember, this episode will be on our website, AbsoluteTrustCounsel.com. You can always schedule an initial appointment with us. We don't charge for that, just to figure out what you need help with. Go ahead and reach out to us. I would be very honored and happy to help you. Thank you again for tuning in, and I look forward to connecting with you next time.